Okay, I already started to talk a little bit about this to begin with, but now we're going to talk a little bit more specifically. Classifying assets and liabilities based on their liquidity. Assets and liabilities are classified as either current or long-term based on liquidity. Liquidity is a measure of how quickly an item can be converted to cash. As I mentioned to you earlier, cash is the most liquid asset that we have. Accounts receivable is relatively liquid. Inventory is less liquid, but still pretty liquid. Equipment and buildings are even less liquid. So you can already see that the order of liquidity in terms of assets will start with cash, accounts receivable, inventory, equipment. If you recall, when we looked at the balance sheet earlier, I explained to you why assets were listed in the order that they were listed. Now, when we're classifying assets, we're going to actually classify them on the balance sheet as current and non-current. I think we've talked about this already, but let's go ahead and talk about it again. Current assets, most liquid. Current assets are converted to cash, sold, or consumed within 1 year or the operating cycle, whichever is longer. But a business operating cycle, you should remember that for textbook purposes, but for the most part, nearly every business runs on a fiscal year, so we're going to be looking at 1 year. So the example of current assets, so we're talking about assets, all of assets, we know what the definition of an asset is. Asset is a cost that has future value. But now we're going to take the total assets and break them down into two categories. Current assets are going to be converted to cash or sold or consumed within 1 year. And non-current assets are going to be all assets not classified as current. The examples are plant assets. Examples include land, buildings, furniture, fixtures, and equipment. Now they're listing it here as long-term assets, which is technically correct, but I think you need to get used to seeing it as non-current assets. Liabilities are the same concept based upon liquidity. Current liabilities, so we know what total liabilities. Liabilities are future obligations, something that it's owed. Something that is owed. Current liabilities, though, are due within 1 year. We have to pay it within 1 year or operating cycle, whichever is longer. But like I mentioned to you before, for practical purposes, remember that it just has to be paid within 1 year. For textbook purposes and exam purposes, you have to add that operating cycle. The examples of current liabilities, these are obligations, accounts payable, short-term, it isn't listed here, but short-term notes payable or due within 1 year. Salaries payable, unearned revenues, interest payable, income tax payable. These are all considered to be current liabilities because you're going to have to pay these within 1 year. Long-term liabilities, now this term does work. Long-term liabilities, you will see it listed this way on financial statements. All liabilities that are not current, and that means that they are due or they become payable longer than 1 year. So you don't have to worry about paying it until after 1 year has expired or longer. Many notes payables are long-term, mortgage payable, bonds when we get to that point. So here's an example of a classified, and that's how we refer to it, a classified balance sheet, which is required by GAAP, by the way, but a classified balance sheet breaks or lists our assets and liabilities in more detail. It lists assets as current or non-current, and liabilities as either current or and long-term. Okay, so you can see the breakdown here. Study it for a bit, and you'll get a good feel for how a typical financial statement or balance sheet is reported when we use classified balance sheet. Next slide explains about the formats for financial statements. Balance sheet formats are report and account, and income statements are single step and multi-step. We're going to focus in more on the income statement in terms of single step and multi-step. When we looked at a single step, we're simply looking at revenues minus expenses and net income. That's what we looked at so far earlier. That's what we've looked at so far. And that's actually pretty common. A single step income statement is pretty common for a smaller service company. A multi-step format is going to be used primarily for companies that have cost of goods sold, products that they sell. So as an example, Walt Disney Company, first you have service revenue. You break it down showing more specific service revenue and product revenue. You get total revenues. Then we have the cost of services and cost of products, which then leads us to what we refer to as gross profit on service and products. So gross profit. So the multi-step is going to create layers, making it a little bit more complex, but gives more information to the user so that they can see things a little easier. So the multi-step will include gross profit on service and products. Then we'll have our selling, general, and administrative expenses, depreciation, and then we have what's referred to as income from operations. We may have other income and expense items. Then we have income before taxes, income taxes, and net income. So the difference really is a multi-step is going to give you more layers of information that could be useful in analyzing the financial statements of a specific company. Study that so that you could see the multi-step financial statement. Okay. We're going to analyze and evaluate a company's debt-paying ability. Now, you may want to be asking yourself, you probably are just trying to figure out what's going on, but in the event that you've actually nailed this and you're really on top of it, then you may be asking yourself, well, why do we really need to break assets down between current and non-current, and liabilities between current liabilities and long-term liabilities? And the reason why we do this is because we do want to be able to analyze the debt-paying ability of a company. In other words, is it going to be able to pay its short-term obligations or its current obligations? So when we talk about net working capital, that word is referring to the company's operating liquidity. And generally, companies should have excess current assets over current liabilities. Oh, so that's why we did this, because we want to measure the company's ability to pay its current obligations. Here's what I want you to remember. No company will go bankrupt over long-term debt. Why is that? Well, by definition, long-term debt isn't due for a year, so why would you go bankrupt? You don't owe it right now. Bankruptcy is the result of short-term or current liabilities, something that you owe right now that you got to pay for right now. You owe it. And if you don't have the money to do that, then you're going to go bankrupt. So what investors and creditors like to look at is the net working capital. Let's take a look at what we have in cash and current assets, that which is going to convert to cash in a short period of time. Current assets, and compare that to current liabilities, that which is due within 1 year. Current assets, either cash or what's going to convert to cash within a year, and total current liabilities, that which is due within 1 year. Well, let's compare those because for the most part, we want current assets to be larger than total current liabilities. If it's not, then there's a red flag. That's telling us that this company may be on the verge of bankruptcy. Current assets compared to total current liabilities. Generally, companies should have excess current assets over current liabilities. We can do it in another way as well. We can take current ratio, which is really kind of the same concept, except now we're going to look at it from a perspective of a ratio, which gives us some sense of proportion. So we're going to take total current assets and we're going to divide it by total current liabilities. Now, if they're equal, then the number is going to be 1, okay? If current assets are larger than current liabilities, then you know it's going to be greater than 1. So many successful businesses operate with current ratios between 1.2 and 1.5, greater than 1. If when you compute this, it ends up being less than 1, that's when you know that there's some issues here, which you probably already know that because likely you'll do the net working capital first and figured out that current liabilities is larger than current assets. Well, that's exactly what would, if that were the case, then you will end up with a ratio that's less than 1. So we refer to that as the current ratio, total current assets divided by total current liabilities. The debt ratio, this measures the debt paying ability of the company. So now we're looking at the company's ability to meet its longer term obligations. And generally speaking, a lower debt ratio is safer than a high debt ratio. I will tell you that for the most part, what you're going to have to do to make a determination about a company and whether its ratio is good or bad is you're going to have to be able to get the industry average. How does this company compare to others in the same industry? And if it's a better ratio, then you know it's safer. If it's a worse, then you know it's a little bit more, there's more risk associated with it. So the way we compute this, our debt ratio is we're going to take total liabilities and we're going to divide it by total assets. And like I mentioned to you, a low debt ratio is safer than a high debt ratio. By the way, we've got a whole chapter as well at the end of this course that is really going to be focused on all these ratios as well. So you're touching base on this right now, but for the most part, there'll be a lot more analysis that we'll do at the end of the class. So quickly, we're going to see how the issuance of stock may affect ratios. In this example here, current ratio, if we have $16,966 plus $50, if this is our total, $16,966, okay. If we have $16,966 of current assets, and then we add $50 to our current ratio, if we add $50 of cash, then that increases our current assets. No impact on our current liabilities because we don't owe that money. So it's going to make our ratio look better. So companies may be motivated to issue stock so that they can make their ratio look better. Our debt ratio is also favorably impacted because the debt ratio, if you go back to the computation, total liabilities divided by total assets, total liabilities, 44,710, they're divided by total liabilities, but we're going to add $50 with this journal entry. We're going to add $50 to cash. That's going to 50, and by the way, it's $50 million, but it's $50. We add that to our total. That's going to make this number more favorable. So the issuance of stock has a favorable impact on the current ratio and the debt ratio. These formulas demonstrate that. Now, if we use cash to purchase a building, we're going to use up current assets. We're going to increase non-current assets. What does that do? Well, if we start off with $16,966 and we subtract 20, that's going to reduce our current assets. If our current liabilities remain the same, our ratio is going to be hurt. So by purchasing assets, we end up having a negative impact on our current ratio. On our debt ratio, you'll notice that our debt doesn't change. It's $44,710. And then our total assets don't change at all because we had $92,033. We added $20 of building, and then we subtracted $20 of cash. So you can see that this is a trading of an asset for an asset. So our debt ratio, because we're not paying attention to current numbers, there is no impact to this type of a transaction on the debt ratio. It did have an impact on the current ratio. It had no impact to the debt ratio. Made a $30 million sale on account. Accounts receivable increases, so our current ratio is going to be better because our current assets go up, current liabilities don't change. Our debt ratio is more favorable as well because our liabilities remain the same, but our current total assets increase, so that's a favorable impact. So this works in our favor to have sales have a favorable impact to our current and debt ratio. Collected the accounts receivable for $30 million. Well, that's trading an asset for an asset, so there's no change in assets. But not only that, it's trading a current asset for a current asset. So this really has no impact on any of the ratios. Here we have accrued expenses at the end of the year. That means we have a liability that's increased and expenses that are going to be increasing. So this could almost be pretty obvious that if we have an expense that increases and a payable that increases, that can be too good. So let's take a look. Our current ratio, our current assets are going to remain the same, but we're going to increase our current liabilities, so that's going to have a negative impact on our current ratio. See that, what's going on? Our debt ratio is also going to be impacted negatively because our total liabilities are increasing by the $40, really the 40 million, but 40 here. So are increasing, and there's no change to total assets. There's no change to total assets. So therefore, our debt ratio is impacted negatively. Finally, recording depreciation, we're going to recognize an expense and lower our assets. Well, the current ratio, there's no impact to that because depreciation expense that's not an asset at all. And our current ratio is looking at current asset versus current liabilities. That journal entry has no impact to our current ratio. So we can rest assured there's no impact there. However, on our debt ratio, we are actually reducing our total assets, and reducing our total assets will have a negative impact to our debt ratio. Finally, the last transaction we're going to look at is earned interest revenue and collected cash of $40 million. That's got to be favorable any way you cut it, because we're going to increase our current assets relative to no change to our current liabilities. So that's going to have a favorable impact to our current ratio. And our debt ratio, well, liabilities don't change, so that makes no change to our debt, but our total assets increase by 40, so that's going to give us a more favorable debt ratio, which means the debt ratio would be lower. Okay, that concludes chapter 3.